So recently, radio talk show host Dave Ramsey sparked a great deal of controversy in my industry because he recommended that retirees invest 100% of their assets in equities and withdraw 8% per year with no guardrails. Unfortunately, I don't think so, Dave. He also called his own teammate George a moron in the process and called everyone recommending a less than 8% withdrawal rate stupid and a goober, and it pisses him off. And of course, obviously, many financial advisors, myself included, obviously challenged his advice for reasons that I'm going to go into a bit. But first, I do want to say that Dave has a huge platform, and in the aggregate, he's done a great job advising people how to get going in the right financial direction. So I do want to give him a shout out for that. Certainly his advice to pay down debt and specifically credit card debt. But first, you have to realize that he is not a licensed advisor and he has no clients of his own. So he is not bound by any regulations or held to a higher standard as he would be if he were part of FINRA, the SEC, or held a certified financial planner designation. His interests are to get viewers. He is selling his show, right? He also seems to not understand that most people don't have a nationwide television show and don't have a net worth of over $100 million as he is estimated to have. So sometimes his advice, specifically as it relates to retirement, is a bit exaggerated or reckless in my opinion. I would say, if I had to put a percentage on it, that probably about 80% of what he recommends is great, solid advice. But you certainly need to do your own due diligence when it comes to his retirement advice, and here are 4 reasons why as it relates to his relatively high recommended 8% withdrawal rate. All right, now I'm going to list the 4 reasons, and then I'm going to go into a little bit more detail on each one. First, Dave has a very simplistic approach here and does not consider the effect of market volatility and sequence of return risk, very important. Second, the false assumption that stocks will consistently deliver double-digit returns. Third, his advice lacks the importance of diversification, particularly the role of bonds or other fixed income investments for mitigating risk. And finally, Dave definitely overlooks the difference between geometric and arithmetic returns. Market returns are very lumpy, as I'm sure you've witnessed if you've been invested for any amount of time. Now, for a bit more color on each. First, sequence of return risk. This is the risk that poor investment performance early in retirement, when investors start to withdraw from funds in their portfolios, this can have a lasting negative impact. This is because the withdrawals during a market downturn can deplete the portfolio more quickly, leaving less capital to benefit from potential market recoveries in later years. Also, positive returns in the early years can obviously provide a buffer against later market downturns. That's called managing sequence of return risk, and it's crucial, especially for retirees who are living and relying on their investment portfolios to fund their expenses. This is why we use strategies that may include having more conservative asset allocation than what Dave recommends. So we have funds to draw from during market downturns. We call this the war chest at my firm. The key factor in influencing market portfolio success is market performance in the initial years, because bad returns early on in retirement can lead to higher risk of failure. Obviously, we want to avoid that, right? Second, market volatility. If we look at historical return scenarios, specifically during times of large negative returns, this is going to show us why funding 8% inflation-adjusted withdrawals with 100% equity portfolio can cause us to run out of money too soon. The data shows us that retirees adopting this strategy faced significant declines, especially during economic downturns like the Great Depression or during 1973 and 1974, and during more recent market collapses like 2008 and 2009. Since 1900, there have been large 15-plus year periods of time where the stock market has provided no returns at all. And there is one example that shows how following Dave's advice in the early 2000s could have led to running out of money in as little as 13 years. And about 40% of the time, you would run out of money in under 30 years using his strategy. So that's pretty bad odds when you only get one retirement, right? Third, diversifying with bonds and other fixed income. Now, obviously, Dave's advice might sound great, but it does carry more risk. Most times, it's not going to be prudent for retirees to rely solely on stocks for their savings. Bonds, treasuries, and other fixed income sources are going to play a crucial role in mitigating downturns and contributing to a safer withdrawal rate by minimizing sequence of return risk. Fourth, geometric versus arithmetic returns. Now, what in the world does that mean? Well, a 12% average return does not translate to a consistent 12% annual growth for a retiree's portfolio. As I mentioned earlier, returns are lumpy, right? Now I'm going to throw a few numbers at you for this example, so forgive me. If you had $1 million invested in stocks and you experience a 20% decline, the portfolio value is obviously going to decrease to $800,000. And if the stocks increase the next year 25%, they are going to rebound to $1 million. Now, the average annual return calculated by combining the negative 20% and the positive 25% is 2.5%. Despite this average, the final portfolio value is going to remain the $1 million. So in essence, the actual return in this scenario is 0. Now, this discrepancy between arithmetic returns, 2.5, and geometric returns, 0, is very critical, obviously, right? Because investors cannot spend arithmetic returns. We're going to be subject to the geometric returns. And the greater the volatility in the investment, the more pronounced this difference is going to be. And this scenario didn't even account for withdrawing $80,000 or the 8% that Dave recommends, which would obviously make the geometric returns negative. His strategy also says nothing to the tax liability of the account that you're going to use to withdraw from. If this is a pre-tax IRA or 401k, the odds of running out of money too soon are even higher. Be fair, there are situations where Dave's 8% withdrawal strategy might succeed. If you have a short time horizon, like a decade or so, this more aggressive strategy is feasible. Dave's strategy might be suitable for those with a shorter time horizon or health issues, but not for those with a life expectancy of 30 plus years. We like to use a dynamic guardrail withdrawal strategy, which means we advise clients to withdraw more than the traditional 4% rate, but not as high as the 8% rate that Dave recommends. It's usually somewhere between 5 and 6%, and you have to be willing to follow a few rules in order for it to work properly. But if you are willing to follow those rules, which pertain to investments and increases and or decreases in amounts that you're going to withdraw in response to market fluctuations, it's obviously going to pay out higher than the traditional 4% rate, and it's going to help mitigate the sequence of return risk if you bump through a guardrail. And this is going to put the odds ever in your favor. So bottom line, there's no question that Dave has made an important contribution to promoting financial responsibility. However, his stance on retirement spending is a bit narrow and short-sighted in my opinion, and I would highly recommend investing according to the experts who have extensively studied safe withdrawal rates over time. Yes, the same experts that he rails against in his rant on his show. Ultimately, the debate does underscore the diversity of opinions within the financial planning community, and of course, the importance of every tailor-made approach for each household or individual. Please feel free to reach out if you'd like to have a discussion on a safe withdrawal strategy for yourself. Once again, Tim Doehrmann here, founder of Eagle Ridge Wealth Advisors, and if you would like to see how we help our clients get the most out of their financial lives in retirement, please visit us at erwealth.com, and we hope to see you there.